Hello everyone, my name is Chad Dunction and welcome to this video on the introduction to the statement of cash flows. Statement of cash flows is the fourth major financial statement that we're going through in this accounting class. Just kind of a quick recap. The income statement, you remember, it is revenues minus expenses to get us to our net income or our profit or loss for a period. It is a good number, valuable to investors. They want to see a good solid net income. But we talked about some of the limitations that go into net income as well, such as the estimated expenses, bad debt, and warranty expense, and all that, and such as the timing of revenues and all of that. Maybe they're not collected yet, or they're fully earned. So income statement, great for showing profit and loss, but does have some limitations. Second, the balance sheet. The balance sheet was a snapshot in time showing what the company owns or its assets compared against who has claims to those assets, the liabilities or what the creditors own, what we owe to other people, and then there's the equity, which is the ownership interest. Okay, the balance sheet is great for creating ratios and looking at the value of a company, but it does have some limitations as well, as we discussed with historical costs that is used. And again, some of the estimates that go into the income statement, they also get passed down to the balance sheet. The third major statement is the statement of retained earnings. So that statement, if you recall, is just showing what we are doing with our net income. Are we sending it out to our shareholders in the forms of dividends, or are we just adding it on to our equity section and holding it to invest in the company at some future point in time? And finally, what we're going to start digging into now is the statement of cash flows. So the statement of cash flows turns out could be one of the most important for an investor. It is going to show how the cash account on our balance sheet has changed from one period to the next. Okay, so if you're an investor and you're looking and you see a company that has a great net income, but yet their cash account on their balance sheet is really dropped, that might make you wonder, well, if this company has a good net income, they should be making money. Their cash should be increasing. We can go to the statement of cash flows to determine why the company is losing cash. Maybe they had to pay off a large amount of debt at a certain point in time that has been expensed over the life of the debt, but now it's time for principal repayment. Maybe they went out and made a large purchase of property, plant, equipment. Okay, and of course the inverse could be true as well, where a company could show a bad net income, but yet their cash has increased by a large amount. So the statement of cash flows is just another one of these. It kind of helps put the whole view of a company together. And as if you go further into accounting, finance classes, you are going to do some financial analysis, and you're going to use the statement of cash flows more when you're going to look at the value of a company with something called free cash flows, which we'll get to later in this unit. Okay, so to start with the statement of cash flows, we're going to do what we always do in accounting, is identify, record, and communicate. Remember, that's what accounting is. First, we have to identify what kind of transaction it is, then we're going to record it, and then we're going to communicate it through a financial statement. And if you notice, I've said this over and over and over again, it's probably a pretty good hint that that's going to be on the final. Okay, but step one, identify. For the statement of cash flows, we are only going to be looking at cash transactions, okay? Stuff that makes cash change hands. And we're going to put them into three different categories. We're going to have an operating section, an investing section, and a financing section. Okay, so when we go through and we start looking at different transactions that a company has, and we're analyzing it, the first thing we're going to do is we're going to identify, is it operating, investing, or financing? Well, our operating is just the day-to-day activity. Okay, what the company does on a regular basis. So stuff we're talking about here, if we're going to be in our operating section, we're going to have a collection or an inflow or a receipt. Okay. Excuse me. those all mean the same thing. Books could word it differently, questions could word it differently, but if you see collection info, it's all cash coming into us. Okay, those are coming from customers, from dividend payments, and from interest. Okay, so anytime if we receive in cash from customers, or we receive dividends, or receive interest, and if you notice, these are things that correlate with revenue. Okay, but we're only looking at the cash from them. Okay, for the payments, which it also could be termed outflows or disbursements. Okay, all those words are used. Payments, outflows, disbursements. We're going to be looking at, payments to vendors, payments for interest, okay, salaries, taxes, okay. So those are everything that we'll be looking in the operating section. Those are our kind of day-to-day normal business activities, okay. All that goes into the operating section of the statement of cash flows. Okay. Next is the investing section. So when we think of investing, normally you're going to think of like your 401k or investing for retirement, going to invest in the stock market. And that is part of investing activities, okay? So if you buy stocks in another company, that is definitely an investing activity, okay? You could also buy bonds in other companies. That is an investing activity. The way this book puts it, and the way I want you to think about it, bonds are debt. So if we loan money to another company, okay, that is what you're doing when you buy bonds. Bonds are a form of debt. You are loaning money. So the question says you invest in bonds or you loan money to another company. That is an investing activity. Okay. And here's the major one that a lot of students forget about. Any transactions that involve PP&E is also an investing activity. Okay. All of these could be inflows or outflows. Okay, we could buy stock in another company. In that case, it's cash outflow. We went out and bought stock. We could have already owned stock in another company and we've decided it's time to let it go. So we sold the stock. The cash we receive for selling that stock is a cash inflow in the investing activity. It's the same way with our property, plant, and equipment. If we've spent cash to acquire new, it is an outflow. And at times, maybe we have used up the property, plant, and equipment, or we've changed our strategy a little bit and we do not need it, so we go ahead and sell it. At that point in time, we get a cash inflow into our investing section. Okay, so as I said, we have stocks in other companies. Important to know that it is other companies because we're investing in bonds or loaning money to another company, and property, plant, and equipment. If we issue stocks or bonds for our own company, that is considered a financing activity. Okay, and remember, bonds is borrowing money. So maybe we do not issue bonds, we go to a bank and borrow some money. That is still a financing activity. So if we're going to get money from issuing stock, taking out a loan, issuing bonds, okay, we could retire our bonds, pay them off. That is an outflow. And when we issue bonds, we would receive money. That is an inflow. Same with money and borrowing. We could buy some of our own stock back. Okay. So we have treasury stock. We briefly discussed that when we were going through our equity section. When a company buys their own stock back, that is a financing activity because it deals with their own stocks and bonds. And finally, down here, when we pay dividends, it is a financing activity. That gets confusing to students sometimes because a collection of dividends from another company is an investing activity. But when we pay dividends, it's a financing activity. Okay? So the best way to get to know these is to just practice them, get used to seeing them. So if you take the hand that I have, go ahead and pause the video, take 4 or 5 minutes, however long you need, to work through, identify on the top part there, those certain events A through M, whether each one is in an operating, an investing, or a financing transaction. Okay? And then when you get done working with that, unpause the video and I will go through them with you. Okay, that wasn't too bad, was it? All right, so let's look at these. So for A, cash collected from customers. Customers, that is an operating activity. Okay, that one is pretty straightforward. We make a sale and we're going to collect it from the customers. B, paid cash to repurchase its own stock. When we repurchase our own stock, that is treasury stock, that is a financing activity. C, borrowed money from a creditor. This is for our own use. We borrowed money, same as issuing bonds. It is a financing activity. D, paid suppliers for inventory purchases. We have to have inventory to run our day-to-day operations, making it an operating activity. E, repaid the principal amount of debt. So when we borrowed money, we created debt. That was a financing activity. That was an inflow of cash because we borrowed it. Now we are repaying the primary principal. It is still a financing activity, but it is an outflow of cash at this point. E is financing because it was our own debt, okay? F, I was trying to where I was there for just a second. We paid interest to our lenders. Even though interest is associated with taking out debt and borrowing money, which is a financing activity, interest paid and interest received is always an operating activity. It is the cost of doing business, okay? The financing is just the principal. You finance for that, but the cost to get that is considered an operating activity. G says we paid a cash dividend to stockholders. Stockholders, that has to deal with our own personal common stock, not another company's. Since it is our own stock that we're worried about, it is a financing activity. H, sold some common stock. Again, it is our own common stock. Using the same logic that we just used in the last question, it is a financing activity. I, we loaned money to another entity. Okay, so we are not issuing our own stocks, or we're not borrowing money here. Here we are loaning money, but that is not our normal course of business. It is an outflow of money, so we're going out, but that is considered an investment activity. So it's like we bought bonds in another company. Or we bought some commercial paper, short-term borrowing that some companies need, okay? Next, we paid taxes to the government. Taxes are just a normal part of operations. They have to be paid. So that is an operating activity. Wages and salaries. Again, you have to pay your wages and salaries in order to operate, operating activity. Purchased equipment with cash. I know you might think, well, we need equipment in order to operate. Maybe, maybe not. Maybe we could do it some other way. But all transactions involving property, plant, and equipment on the statement of cash flows go into the investing section. Okay. And finally, M, we pay bills to insurers and utility providers. Again, is the normal cost of operations. So that is operating. Okay, so there is the first step when you go to prepare your statement of cash flows is you have to look at all the different transactions that are presented before you and divide them up into operating, investing, or financial transactions. Okay, and then we are going to, the next step after we identify is to record. Okay, so that's what we're going to move on to next. We're going to record the operating section, then the investing section, and then the financing section. And then we're going to put all three of them together in order to communicate or prepare the report that we are going to send out to everybody to see, that is going to show the change in cash from operations, the change in cash from investing, change in cash from financing to get us a total change in cash for the period. Compare that to the beginning, add that to the beginning cash balance to get us our ending cash that should be shown on the balance sheet. Okay, but let's not get up our head or ourselves yet. That is the last step. Remember, first, identify whether it's operating, financing, or investing. Okay, so once we have identified all of our events and what we have here, we are going to start recording. We're going to start with the operating section. Okay. There are two methods in order to create or record our statement of cash flows. There's the direct method and the indirect method. Okay. You remember when we do accounting, we're doing accrual accounting for our income statement and our balance sheet and everything. Okay. The opposite of that would have been cash accounting. That is what the direct method involves. Okay. You would have to go back and change all of the journal entries and stuff like that to a cash basis, so where you're only counting revenue when cash came in. Okay, you have to follow cash, or you're going to have to do some very detailed T account analysis. Okay, you move on in your accounting education when you get into your intermediate and advanced classes. You're going to deal more with the direct method, but for this introductory class, we're not going to worry about switching everything over to cash accounting or doing all of the T account analysis in order to find out directly how much cash went in and out. Instead, we're going to use what most corporations use, and that is the indirect method. Okay, the indirect method, we are going to start with our net income, and then we are just going to make some adjustments to it. That is going to get us our cash from operations. Okay, because that is what we are looking for in the operating section of the statement of cash flows, is how much cash was generated from operations. Okay. These adjustments are fairly simple. It's a 3-step process. While I say they're simple, the difficulty comes in remembering what everything does, whether you have to adjust it up or down. Okay. So the first step, we are going to add back non-cash expenses. Okay, because we are taking our net income and we are going to try to relate it to how much cash was changed. Well, we know we have one major non-cash expense that usually comes out every period, and that is depreciation. Remember I told you all PP&E transactions, when we pay the cash in or the cash out for our statement of cash flows, goes into the investing section. Well, on the income statement, it gets taken, that amount of cash gets taken off in some kind of systematic way through depreciation expense. So when we're converting our net income into cash, first thing we need to do is add back that depreciation expense. Okay, here says reminder, depreciation expense equals a debit. Accumulated depreciation equals a credit. So the problems that we go through, it might tell you what the depreciation expense was, or it might say the credits to accumulated depreciations total this amount. Okay, we have to remember back to our lessons on depreciation and then accumulated depreciation credit. So if the credit was $20,000 or $30,000 or $40,000, our depreciation expense for the period is $20,000, $30,000, $40,000, whatever that credit amount is. Okay. Step 2, we have to adjust for our non-cash balance sheet items. Okay. So here we're going to be looking at some current assets and some current liabilities and how they change. Okay. Being at home, don't have a big enough board. I hope you have this all written down because I'm going to need some more room. Okay. So we're going to work on step 2. We're going to adjust some non-cash balance sheet accounts. So we are going to look at this year. So we're at the end of the year, getting ready to do our statement of cash flows. And then we're going to look at previous years. So we're going to compare 2 years. For our current assets, if the balance in our current assets increase, we are going to do the opposite. We are going to subtract it from our net income when we're making that adjustment. Okay. If the balance goes down, we are going to add that amount to our cash. So let me give you an example here and show you how this works. So say we had beginning inventory of $100. Okay. We made purchases of $100. Makes our inventory 200, okay? But say on our income statement, our cost of goods sold was only 50. Okay, because we match our cost of goods sold with our revenue. So we are lowering our cash by $50 on the net income per se from our revenue. Okay. On our books, when we make it, we take off our cost of goods sold, makes our ending inventory 150. Okay. So if we're just going to go with our net income, it's only going to show basically an outflow for the cost of goods sold at 50, but we actually purchased 100. So in order to get that, since our beginning inventory was 100, our ending inventory was 150. Number went up, so we need to subtract it from our cash. So we're taking 50 out. So our adjustment is the 150 minus the 100, so a 50 adjustment plus our 50 COGS, and we equal the amount that we purchased. Okay, so that's why it can get difficult doing the direct method. It is kind of a simple direct method explaining on how we got it there. See, we could follow all these T accounts to find out where exactly the cash was paid. But by simplifying the logic, when our current assets, it's going to work for all of them. Our current assets go up, we need to subtract the amount that went up from net income to find out how much cash was actually spent. If the amount goes down, we need to add that amount to net income because we spent more than was actually put onto our balance sheet, okay? The major accounts you're looking for under current assets are accounts receivable. Okay, that is going to adjust for our sales. Okay, we record sales when they occur. People are going to pay us later. We're going to make an adjustment for accounts receivable for the cash that was actually collected. Inventory. Inventory, as I went through, is because of the cost of goods sold adjustment we need to make from our taking our income to a cash basis. And finally, prepaid expenses. Okay. The prepaid expenses went up, it is because we paid more cash out. There's not getting expense on the income statement, so they're never coming off. So that's why we need to lower it, to take the cash back down to where it should be. Current liabilities, on the other hand, follow the pattern exactly. If current liabilities increase, we need to increase, making an upward adjustment to our net income. If our current liabilities go down, we need to make a decreasing adjustment to our net income. The same principle applies. If you think about it here, let's say we have income tax expense of 100 on the income statement. We did not pay it, so that means we have an income tax payable of 100. If our income tax payable at the beginning equaled 0, it would have increased by $100. But we have an expense lowering our net income, but it was a non-cash expense, so we need to add it back. Okay, that's because the liability increased. Again, that is a simple T account, not a T account, but in a simpler form, how the logical reason why when a payable increases, we need to add the cash back. We are going to be again looking for three main things down here. You have accounts payable. That would be for vendors, okay? Stuff that we got in helps another adjustment for the cost of goods sold. We're going to group everything else into accrued liabilities, almost everything else. This would be like utilities payable, salaries payable, okay, stuff like that. And finally, income tax payable, okay? So those three are our three main current liabilities we're going to look at. It's going to be very important that you remember how these effects go. You're going to have to remember that for your test and when you're making these indirect statements. Okay. Current assets do the opposite. Okay. The current assets increase from year to year means you need to subtract them out of your net income. Your net assets go down from year to year, add them back in. Well, current liabilities match it perfectly. If the current liabilities increase, add it to your net income. If the current liabilities decrease, subtract it from your net income. Okay. I dropped my eraser on the ground here. The third and final step in doing the indirect method, if you remember, the first step was add back the non-cash expenses such as depreciation expense. Second step is make adjustments with the current assets and current liabilities we just went through. And finally, the third step is you have to adjust for gains and losses. Gains and losses arise whenever we sell property, plant, and equipment. If you remember, we were talking back in those chapters, or we sell some securities, stuff that's not our normal course of business, so it doesn't get counted in the operating section of the income statement. It goes down in that other section as other gains and losses. So it is still part of net income, but not part of the operating income. Well, the gains and losses, we are going to account for them in the statement of cash flows in the investing section with all PP&E transactions and all investments in other companies. So we just need to eliminate these totally, okay? So we are going to subtract out any gains and add back any losses when we're making those adjustments to our net income, okay? So that's pretty straightforward, step number 3. So let's look at a problem here. Go ahead and get your handout out. Let's go ahead and work through this together, okay? We got for the year just completed, Hanna Company had a net income of $35,000. Balances in the current assets and current liability accounts were as follows. So we have a beginning balance and ending balance given to us. And it also tells us here that the accumulated depreciation account had total credits of $20,000 during the year, and they did not record any gains or losses. So we don't have any gains or losses. Well, that's good. I already know that step 3 up there, adjust for gains or losses. We do not have to worry about that. Very nice. All right, prepare the operating section of the statement of cash flows. When we're doing the indirect method for the operating section, we always start with our net income. Here, our net income, $35,000. Okay, put that way over on the right. I'll have a column A, a column B, a column C. Okay. From there, we make our adjustments to this following our 3 steps. Step number 1, add back any non-cash expenses. In this case, what I told you about is depreciation expense. Looking through the problem, the only time it mentions depreciation is when it says the accumulated depreciation account had total credits of $20,000 throughout the year. Remember, accumulated depreciation had credits of $20,000. That means depreciation expense had to have a debit of $20,000 as well. So we need to, step 1, add depreciation expense. Okay, we are going to add that back. I'm going to just put them all here in this total, and then I'm going to get a total adjustment line put over here, and we'll make our adjustment. Okay. Step 2, we have to analyze all the balance sheet accounts. Okay. So first, our accounts receivable. On the right-hand side was the beginning of the year was at $40,000. So was at $106,000. I'm sorry, I was looking at the cash and the cash equivalents. Wrong numbers there. So make sure you always get lesson there. Make sure you get the right numbers. So look at our accounts receivable. At the beginning of the year was $106,000. At the end of the year was $125,000. So some quick math tells me that that went up $19,000. Okay. When a current asset changes, the effect on the cash flows is the opposite of what happened. So it went up $19,000. I need to make an adjustment downwards or subtract $19,000. The inventory, on the other hand, went from 180 to 213. It went up 33,000. The same as receivables. Current asset, when it goes up, I do the opposite. Subtract 33,000. The prepaid expenses went down 1,000. As an asset, it gets the opposite. The amount decreased from 7,000 to 6,000, so I will add that back. We're still in step 2 now, moving on to the payables or the liabilities. Whenever they have a change, remember they follow right along with how it changed. So our accounts payable went from 195 to 210, or it went up $15,000. So we will add that. The accrued liabilities went down by $2,000. So we will subtract those. And our income taxes payable increased. Again, liabilities follow exactly right along, so it increased. So I am going to adjust it by adding that amount. It went from 30,000 to 34,000. Our total adjustments by 20 minus, minus, plus, plus, minus, minus. We get there, find out we need to make a total downward adjustment to our net income of 14,000, making this line cash from operations of $21,000. So that is just the top section of the statement of cash flows, okay? We're going to go through and do the operating section. Underneath that will be an investing section. Underneath that will be a finance section. We'll get through those 2 sections the next time. We'll start off with a review of this. We'll work through another problem like this again. We'll add in a gain or a loss. We'll get a little more detailed. Some of these numbers, we'll practice it again, used to doing it, and then we'll move on and we'll finish up on how to do the investing section and then the financing section. And then we'll wrap it all together and we will put a statement of cash flows together in good form. Okay, so go ahead and get started practicing on this, and I will see you guys next class.